Value Averaging by Michael Edelson is a unique book that proposes a new method for investing that combines the best features of dollar cost averaging and value investing. The author argues that this approach can help investors achieve their long-term investment goals while minimizing risk. Edelson's approach involves adjusting the amount of money invested each period based on the difference between the current value of the portfolio and the target value. By investing more when the portfolio is below the target and less when it is above, the investor can take advantage of market fluctuations while maintaining a disciplined approach to investing. While some of Edelson's claims may be controversial, value averaging offers a compelling argument for a new approach to investing that could be useful for both novice and experienced investors. With its clear explanations and practical advice, this book is a valuable resource for anyone looking to improve their investment strategy.
As investors, we are constantly reminded to buy low, sell high. However, the reality is that many of us struggle with this seemingly simple concept. It's easy to get caught up in the excitement generated by the media and the market, leading us to buy high and sell low. The fear of investing at the bottom of a bear market, combined with the hype surrounding a soon-to-be-ended bull market, can make it challenging to follow this advice. Market timers and fundamental analysts have their own methods of trying to navigate this tricky terrain, but most investors don't have the time, experience, or resources to play their game. We can either pay for their assistance, which may not be worth the cost, or strike out on our own, navigating the emotional hills and valleys of the market. This is where formula strategies come in. A formula strategy is any predetermined plan that mechanically guides your investing. These strategies help you avoid the herd mentality and its arbitrary and often ill-timed investment shifts. They also help guide you in the general direction of buying low and possibly selling high. One of the best-known formula plans is dollar cost averaging, where you invest the same amount of money in an asset each regular investment period, regardless of its price. A flexible variation of this is value averaging, which was devised in 1988. The basic formula of value averaging is to invest whatever is needed to make the value of your asset holdings increase by some preset amount each investment period. Other formula strategies call for rebalancing your holdings among asset types. For example, constant ratio plans dictate that a fixed percentage of your wealth should be held in stocks. Some more active versions of formula strategies are really more like market timing, where the proportion in each asset type changes based on some fundamental or technical indicator, such as dividends, P/E ratios, or short interest. Asset allocation strategies generally fall into this category. In this book, we will focus on the more passive formula strategies, specifically dollar cost averaging and value averaging. These strategies are simpler and less chancy for the investor. The first 3 chapters provide basic information on formula plans, particularly dollar cost averaging and value averaging. Dollar cost averaging helps a bit on the buy low side, but it provides no guidelines for selling. Value averaging has the effect of exaggerating purchases when the market moves lower but buying less and sometimes even selling shares when the market moves higher. The latter is a bit more complex but well worth considering, given the added flexibility and generally higher returns. As investors, we can't predict the future of the market, but we can control our actions. By implementing a formula strategy, we can take the emotion out of our investing decisions and follow a predetermined plan. This will help us buy low and possibly sell high, improving our chances of achieving our investment goals.
Chapter 3 of Value Averaging by Michael Edelson is dedicated to explaining the concept of value averaging and how it differs from other investment strategies. At its core, value averaging is a strategy that seeks to keep the value of an investment portfolio on a predetermined path by adjusting the amount of money invested each period based on the difference between the current value of the portfolio and the target value. Edelson first explains how investors should set a target value based on their long-term financial goals and risk tolerance, and how to calculate the amount of money that should be invested each period to achieve this target value. He emphasizes that the key difference between value averaging and other investment strategies is that it requires investors to adjust their investments based on the performance of the portfolio. The benefits of value averaging are illustrated through several examples. Edelson argues that this strategy can help investors achieve their long-term investment goals while minimizing risk. By investing more when the portfolio is below the target value, investors can take advantage of market downturns and buy stocks at a discount. Conversely, by investing less when the portfolio is above the target value, investors can avoid over-investing in stocks that may be overvalued. Edelson also explains how to implement value averaging in practice, providing step-by-step instructions and helpful tips. One of the strengths of this chapter is Edelson's use of real-world examples to illustrate the benefits of value averaging. Overall, Chapter 3 of Value Averaging is a valuable resource for anyone interested in improving their investment strategy. It provides clear explanations of the concept of value averaging and how it can be used to achieve long-term investment goals. Edelson's practical advice and instructions make it easy for readers to implement the strategy and become more disciplined and successful investors.
Michael Edelson concludes his book by summarizing the key concepts of his investment strategy and providing some final thoughts on the benefits of value averaging. Edelson reiterates that value averaging is a disciplined approach to investing that seeks to keep the value of an investment portfolio on a predetermined path by adjusting the amount of money invested each period based on the difference between the current value of the portfolio and the target value. By investing more when the portfolio is below the target value and less when it is above, investors can take advantage of market fluctuations while maintaining a disciplined approach to investing. He emphasizes that value averaging is not a get-rich-quick scheme but a long-term investment strategy that requires patience and discipline. The key to success, according to Edelson, is to stick with the plan and not let emotions or short-term market fluctuations derail the investment strategy. Edelson also addresses some common misconceptions about value averaging, such as the idea that it is a market timing strategy or that it requires investors to constantly monitor the performance of their portfolio. He stresses that value averaging is a passive investment strategy that requires only periodic adjustments to the amount of money invested, rather than constant monitoring and adjusting. In addition to discussing the benefits of value averaging, Edelson also acknowledges some of the criticisms of the strategy. For example, some critics argue that value averaging can lead to overinvesting in a declining market, while others argue that it can be difficult to implement in practice. However, Edelson maintains that these criticisms can be addressed by using a well-designed value averaging plan and sticking with the plan over the long term. Overall, Chapter 12 serves as a useful summary of the key concepts of value averaging and a reminder of the importance of disciplined, long-term investing. Edelson's clear and concise writing style makes the chapter easy to understand and the perfect conclusion to his informative and insightful book.